Hey everyone, welcome back to Corporate Decoder, the place where we like to say that numbers don't lie, but they can be a bit shady. Get ready for some serious financial unpacking as Hooker Furnishings drops its latest quarterly report. Hooker Furnishings, a name that instantly brings to mind comfortable living rooms and elegant dining spaces, has released its financial report for the quarter ending the 2nd of November, 2025. And folks, let's just say it has been a quarter of significant shifts and some tough decisions. Let's dive straight into the numbers, because that is where the real story often lies. Looking at their balance sheet, we see total assets sitting at around $240 million as of the 2nd of November 2025. That is down from over $313 million just a few months earlier in February. Where did that money go, you ask? Well, a big chunk of it went towards paying down debt. You see long-term debt dramatically decreased from about $21.7 million to just $3.8 million. That kind of debt reduction is usually a good sign, signaling financial discipline. Now, let's talk about the top line, the sales for the 13-week period ending the 2nd of November 2025. Net sales were about $70.7 million. That is a noticeable dip from $82.7 million in the same period last year. And looking at the longer 9-month period, sales dropped from $233.1 million to $211.2 million. This decrease in sales is a recurring theme, and the company links it to a few key factors. One of the biggest developments impacting these numbers is the decision to sell off certain brands, specifically the Pulaski Furniture and Samuel Lawrence case goods brands, previously part of their Home Meridian segment, are on the chopping block. Management felt these brands, which are more value-oriented, were no longer a good fit for their long-term strategy and had been struggling due to economic pressures and tariffs. This is a significant move, and it means the Home Meridian segment as a whole is being restructured. The impact of this strategic shift is quite visible in their income statement. For the 13 weeks ending the 2nd of November 2025, the company reported a net loss of a little over $21 million. A big chunk of that loss, about $15.6 million, comes from non-cash impairment charges. This means they revalued certain intangible assets, like goodwill and trade names, and had to write down their value. This often happens when a company faces tough economic conditions that make future earnings from those assets look less certain. These impairment charges really tell a story about the current economic climate and how it is affecting the furniture industry. The company specifically mentions declines in market value and changes in market dynamics as triggers for this assessment. It is a non-cash charge, meaning it doesn't directly affect their cash on hand, but it does hit their reported profitability. The decline in net sales is spread across different segments. The all other category, which includes things like their hospitality business, saw a massive drop of over 76% in the third quarter. This is directly tied to the timing of large projects that shipped in the prior year. The Hooker branded segment, however, showed a small increase in net sales of 1.1%, and the domestic upholstery segment also grew by about 3% in the quarter. This shows resilience in their core businesses. Despite the lower sales, the overall gross profit margin actually improved. For the consolidated company, gross margin went from 24.8% last year to 25.6% this quarter. This suggests they are managing their costs of goods sold more effectively or passing on some increased costs to customers through higher prices. The Hooker branded segment in particular saw its gross margin improve significantly, benefiting from price increases and reduced discounts. On the flip side, selling and administrative expenses also saw a reduction, dropping by about $5.9 million in the third quarter. This is a direct result of their cost reduction initiatives, which the company states have exceeded their initial goals. This is positive news for their operational efficiency. However, when you put it all together, the company reported an operating loss of $16.3 million for the quarter. As mentioned, this is heavily influenced by that $15.6 million impairment charge. Excluding that, the operational performance looks a bit better, but still faces challenges. The 9-month period also shows a substantial operating loss. Again, largely due to the impairment charges. The decision to sell the Pulaski and Samuel Lawrence brands is a major strategic pivot. By shedding these brands, which contributed about 15% of consolidated net sales, the company is aiming to streamline its operations and focus on more profitable areas. This move is intended to position Hooker Furnishings for consistent long-term performance. Looking at cash flows, the company generated $22.9 million from operating activities for the 9-month period ending the 2nd of November 2025. This is a significant turnaround from a negative $11.9 million in the prior year. A big driver of this improvement was better management of working capital, particularly lower inventory levels and improved collections of trade receivables. This indicates better operational control and cash generation from their core business activities. Financially, Hooker is relying on a revolving credit facility of up to $70 million. As of the 2nd of November 2025, they had about $4.1 million in outstanding loans and $2.1 million in letters of credit, leaving them with considerable availability. This credit line provides them with important liquidity, especially during periods of transition. So, what is the outlook for Hooker Furnishings? The company acknowledges ongoing macroeconomic headwinds like inflation and tariffs. However, they highlight positive signs like increased incoming orders for their Hooker branded and domestic upholstery segments for 2 consecutive quarters. With a more focused portfolio and what they describe as a sharper portfolio, they believe they are better positioned to navigate these challenges and drive profitability. The sale of these brands, a subsequent event after the quarter's end, is expected to close by mid-December. This transaction, valued preliminarily at around $4.6 million plus the assumption of lease liabilities, will further reshape the company. It is a clear signal of their commitment to shedding underperforming assets and concentrating on their stronger brands. Now, looking at these results more broadly, Hooker Furnishings appears to be in a period of significant transformation. The divestiture of struggling brands is a sound strategic move to focus on core strengths, and the improved cash flow from operations is encouraging. However, the substantial net loss and the significant goodwill impairment charges underscore the challenges they are facing in the current economic climate. The company is clearly working to size its operations and improve its profitability. The key will be executing on their strategy, managing their costs effectively, and seeing if their core businesses can truly drive sustainable growth. The furniture industry is notoriously cyclical and sensitive to consumer spending, so continued vigilance and adaptability will be crucial. Alright, that is our breakdown of Hooker Furnishings' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.